Hello, welcome to Chapter 3 of the Osborne AAT Level 2 Bookkeeping Controls book. I'm going to do bank reconciliations today. So the previous two chapters really have been setting up this bank reconciliations, which is a very important thing for accountancy. It's the fundamentals of just checking whether your figures are accurate. And so, remember in the introduction, I introduced some concepts in terms of accuracy and that we were going to be professionally skeptical. So we've got this cash book. We've been producing it. Why are we bothering to check this to the bank statement when we got this cash book that's telling us what the answer is anyway? And we've got two things going on here. On the one hand, we're checking it for accuracy, and on the other hand, we're sort of professionally skeptical. Either on the one hand, we think that there's a possibility of errors, and there's also as well the possibility that people are committing fraud against us. So on the one hand, we want to check this thing is accurate. And we want to check for fraud as well, so we're being professionally skeptical. On the other, there are things in the bank statement that we don't know about, and will never hit our cash book unless we check it on the bank statement and update our cash book. So that's why we check it. Now, that's why we do this bank reconciliation. On the one hand, professional skepticism, protecting from fraud and what have you, and getting it accurate as well. And making sure that we haven't made errors in what we've already posted. And on the other, there's going to be things that we don't know about that are in the bank statement that we need to update our cash book with in any case. So that's why we're doing bank reconciliations. We're sort of checking our cash book to our bank statement, and we're doing this thing. This bank statement's a brilliant piece of external evidence that we've got that we can use and check our information to our cash book. And so every time that we get a bank statement, then we're going to check, I'm going to do this bank reconciliation pretty much every time that we've got them. Some companies will do them monthly, some will do them weekly, and the larger companies, my finance departments, I will be doing them daily. I like to have them daily. I find it useful as well to check. If you remember in the previous chapter, I was saying, well, is my department I've seen examples in the past. Have I got people just going along to the bank whenever they feel like it to post our checks in? Well, the bank statement's really useful for that because I can have a good look through it and see a couple of, and see how long these checks are taking to clear as well. And that pretty much tells me whether somebody's been taking a long time to go to the bank, or I'm only cashing. I've got cash lurking around in safes that I don't really like. So that's why it's useful, very useful for the professional accountant to check through. As an auditor as well, you start here, you check the cash position, and you do a bank reconciliation. So also very key, important for every accountant to know how to do this. So I've got this cash book and I've got this bank statement. Are they going to be the same? And the answer is probably not. In fact, it's going to be no. And there's going to be two things that are going to be why the bank statement and the cash book aren't going to be the same. One, as we've had in the previous chapters, the timing differences. So I posted things to the cash book, but they actually haven't either cleared, and they haven't cleared somebody else's, well, our bank account yet. So either payments that we've made in or payments that we've made out, they're in the cash book, but they haven't cleared the bank statement yet. So there's going to be timing differences in these payments. Either payments that we received in or payments that we're making out. There's also as well going to be things on the bank statement that we don't know about. Things like bank charges and what have you. I'll take you through those in a minute. So in the timing differences, what's the technical terms here? So we've got two technical terms. We've got outstanding lodgements, and all that is payments that we've made into the bank. So we're making payments into the bank. Debit balances that you will be seeing on your cash book, that you put in your cash book, or credit balances that should be on the bank statement but aren't there yet. So they're debit balances on your cash book, but they haven't made it into the bank statement yet. They're not appeared as a credit balance in the bank statement. As a consequence, your cash book, your debit balance on your cash book will be higher than the credit balance on your bank statement. You'll be saying that you've got more cash than you actually have in the bank. Yeah, so there's a timing payment there. So a payment into the bank that hasn't cleared is an outstanding lodgement, and that's just what it's called. A payment that you've made out, so out of your cash book, so you've written check out, what have you, or a payment that you've made out in there that hasn't cleared the bank account yet, is called an unpresented check. So in that instance, your cash book is going to be lower. The debit balance in your cash book is going to be lower than the credit balance in your bank statement, because there's a payment in your cash book that hasn't actually been a payment in your bank statement yet. So that's how we're going to have. So the first thing is going to have is timing differences. The second thing that you're going to have, which is going to make the bank statement and the cash book different, is things that you don't know about, things that are on the bank statement, but actually you didn't know about them yet, and so they haven't been posted into cash book because you couldn't possibly post them in. So there are things like bank charges. So bank charges that have been made to you in the bank statement, bank interest that you've either received or been charged. Yeah, you wouldn't know about those until they're actually in the bank statement, and then you've got to put them in the cash book. Payments that you've received in automated payments that you received into your account, or automated payments that you might have made out that you haven't put into the cash book. Typically, these can be back payments in. You probably would have posted your payments out already, but those will be payments in the bank statement that aren't in the cash book yet, because you wouldn't have known about. Dividends. Companies will pay you dividends, and you wouldn't know about those. And then you'll have these things of bounce checks, which are known as referred to drawers, where it's appeared in the bank statement, but actually as it's gone through the system, they found that there was no money in this account, so they just sent them back and bounced it, and it comes back out. And they refer to drawer, and then you've got to go and sort it out. Typically, actually, you get hit with the bank charge as well, so it seems a bit harsh. So these items are missing from our cash book. Now, to be harsh about it, effectively they're uncorrected errors at this time, because if we haven't updated the cash book, well our cash book's actually got an incorrect figure. The person who's producing the cash book would say that's not fair to call them an error, but they just are. Their difference is the cash book should be a different figure. It's not been corrected yet. So, how are we going to do this? Because we've now got this. We want to have this point where we're checking our cash book to our bank statement and be happy that our cash book is accurate. But we've got these timing differences and these things that we don't know about. So we've got, what I'm going to give you is just a 4-step method to do the bank reconciliations. And all you're going to do in these bank reconciliations is follow this 4-step method again and again and again. I'm going to give you the exam version here because the point of this is for you to pass the exam. In real life, it's slightly different. Step 2 is before step 1, but in the exam, step 1 goes before step 2. And I'll explain to you why in a second. We've got 4 steps that we're going to go through. And what I'm going to do is I'm going to do this with a natural example. So here we go. I've got I think I've taken the workbook here, page and bank reconciliations. I think it's page 13, example 3.5 in the workbook. And you're going to typically be given in the exam, and you'll see in real life as well. You've got a bank statement on the one hand, and you've got a cash book on the other. And we've got to go from this balance here, and we've got to find it compared to whatever the balance would be in here. So we would have to add up all of these figures here and find out, and go from this balance to whatever the debit balance will be here, and it'll be different. So how do we do this? Well, let's brought forward balance, wasn't it there? Or carry forward balance there. So how are we going to do this? Step 1. Step 1, you're going to tick off all the items on the bank statement that are also in the cash book. And you're going to tick them all off. Now, with this, do it with a pencil if you can do a decent thin line through it. So don't obliterate it because you might make it an error, but simply make a line through it. Don't faff around with it around the edges here with a little tick or something. Go through it like that so you don't obliterate it. You can come back and check if you want to, but also as well make sure that it makes it nice and clear what are the items that aren't on here. So you can see how this one's got nice little lines through it, and you can quite clearly see, right, okay, these are the ones, these haven't got lines through. That's step 1. Tick the items through. Step 2, now we're going to reconcile the brought forward balances. So you've got this balance here and this balance here, and we're going to reconcile the differences, and it's £855, and that is this one here. And we're going to tick through that. Now, why do I do this step first here and then this step after in the exam? And the reason why is because the examiner cannot give you the previous bank reconciliation, because they would effectively give you the answer of how to do this bank reconciliation, which wouldn't really be much of a test, would it? So they're not going to give you the previous bank reconciliation, so you're not going to see that this was an unpresented check in the previous bank reconciliation. There was a difference between those two. Now, why do I instead of do this step after this step? And the reason why is because I've nicely cleared off these items here, and I know that it's just going to be one of that or that is going to be the difference between those two, and it's 855, and it's just one. Possible that it could be a couple of items, in which case if I was trying to do that step first I'd be trying to do combinations all over the place, and it would take me 10 minutes to work out what it was beforehand. I'm getting a little bit stressed at that point as well. So this just takes the pressure out. And with all these sort of videos, I'm just trying to give you an easy way to try and take the pressure out of your exams, really, more than anything. So do that one after that one in the exam. In real life, of course, you've got the previous month's bank reconciliation because you do them. You're doing the bank reconciliations if you're doing this in real life. So you would have done that step first. You would have just ticked off the previous items and go through. Now, when I was auditing as well, I would do that first. The reason why as well was because I'd be having a bit of a look and seeing if these things are down here somewhere, rather than just after the month end, because I'd like to be seeing if people were fiddling the cash book figure. Coming back to this idea of being professionally skeptical at all times. And we're trying to sort of see as professional auditors what's going on. But in this instance here, I'm setting out the exam approach, and the exam approach is tick off the items in both first, do the reconciliation afterwards. That's step 1 and 1B. Next step. Right, the next step is to redo the cash book. Now, how do we redo the cash book? What do I mean by that? What is on the bank statement? So this is just forget about this side. Leave that alone at the moment. We've worked out what our brought forward balance is actually what our carried forward balance is on this one, and the carried forward balance on this one was it's got 8181 on one side, 6374 on the other. So the carried forward difference between that. I'm then going to redo the cash book. So I'm going to put in this receipt and this payment. So there's a receipt and there's a payment, and there is the new carried forward position. So I wasn't interested in looking at this side. So you see these things that haven't been ticked off yet, leave those alone for the moment. Those aren't important. We do in step 2, or in step 3 in the 4-step method, step 2 in the 3 and a bit method. We just look at the bank statement, and we're just picking out these ones, and we redo the cash book. And that's what our carried forward position should be in the cash book. So effectively, we've cleared the uncorrected errors in the cash book by looking at the bank statement. That's what we've done there. Last step, we now reconcile. Now let's go back to this little thing here. If I made some payments in, so things that would be on the credit side or on the debit side of the cash book, but are not in the bank statement yet, the cash book will be higher than the bank statement. So we'd be going from the bank statement, we'd be adding them on to the bank statement to get to the cash book. If we've made some payments from the cash book that aren't in the bank statement yet, then the bank statement the cash book will be lower than the bank statement. So we'd have to take them off the bank statement to get to the cash book. So let's get to this one here. So we start with the bank statement position, right? Unpresented checks. So payments that we've made out, they're in the cash book, they're not in the bank statement yet. So they've got to be taken off the bank statement figure, because the bank statement figure is going to be higher than the cash book figure. So they've got to be in the minus figure. So these unpresented checks here, this one and this one, must be taken off the bank statement figure to give that. These payments that we've made into the bank statement, that made into the bank, that are in the cash book but not in the bank statement, they need to be added on, because the cash book will be higher than the bank statement. So we need to add them onto the bank statement figure to get to the cash book figure. So those two, these gaps here, added on to this to get to that. So this minus that plus that is the same as that. And that is a bank reconciliation. Now I've given you a chapter, I'll give you a video where I just do bank reconciliation after bank reconciliation. You've got the workbook, and you've got the examples as well. So I take you through those, and I think what you just need to do here is just to go through example after example of that, and then it just sort of sticks in eventually. But if you do those along with me, that will be that's pretty good, really. So should sort of help you with that. Now, what if they were different? What if they didn't reconcile? So this, even after doing these things here, this was a different figure than here. This one reconciles, but what if they didn't? Well, you could have made an error. So you'd have some errors there. You'd have to go back and reconcile and see what it was. So you'd be going through and looking, are there anything particularly close to one another that would be different? And that's really what you're really having to look for. Or what was the difference between the two of them, and what was the cash book entry that was the difference and was not appearing really. So that would be something. I don't think you really have to do that, because that is more what's known as an incomplete records exercise at professional level. So you've got unusual things within the bank statements. So we've got out-of-date checks. So let's say we've got a difference, but it never really clears itself, and they've been telling you that they've had this sort of check, and it's been going on for six months now, let's say. So this 855 actually never really appeared at all. It was never charged. Eventually, you're going to write that back because it's over 6 months old. Typically, I must confess, in real life, you write them back, and you never go and tell the supplier because they're clearly not chasing you for the money. And if you think that people don't make such errors, I can tell you that there was one firm that never chased us for £100,000 once. So it is people do not chase for money sometimes, because people managers move and whatever, people don't understand how who owes what sometimes. You might have something called a return check, which is what's known as a bounce check or dishonoured. So they might appear. And it's possible you could have bank errors. Different errors within backs things there. You put it in the cash book at one figure, but the backs run actually had a different number on there, and it was slightly different. So you need to sort of check for that. And the bank could make some charges to you that you don't actually agree with as well. So you would just get onto the bank sort of straight away and sort those out. And I think then it goes and sort of says, well, what is the reasons for the bank reconciliations? And you've got a whole series of questions. I'm going to give a separate video on the actual detailed bank reconciliation, so I'm not going to do any more here. But what I'm going to go through is, let's go through 3.1 then. So when preparing a bank reconciliation statement, which one is a timing difference? Okay, so remember that we got this sort of step method, and the first method would be to tick off everything. The second method would be to then fix up the cash book things, or redo the cash book, and the third thing then would be to reconcile the timing differences. So an unpresented check, well, that is a timing difference. That's in the bank reconciliation, so that will be that. Unusual to give it the first one, and you can see the next three: direct debit payments, backs receipts, or bank charge and interest. Those are all in the redo the cash book section. So that's not those are not timing differences. A business bank statement shows a balance of £400 in the bank. Unpresented checks total £350, and outstanding lodgements total £200 and £200. So let's just put these there though. So a bank statement will be at 400. So that's now, that figure now is a £400. Unpresented checks would be a minus figure, so that'd be 350. So that takes us down to 50. And outstanding lodgements, what we would add on would be another £200. So that would take us to £250 in debit. So that's what we would have. Okay, and then I think after those questions, you're into bank statement or bank reconciliation lands with bank statements and cash books, and I give you a separate video on that. So I'm not going to do any more. Hope you enjoyed the video. Thanks a lot. Thanks for listening.